What type of commercial property asset should you be looking to buy? Hi, I'm Jared Krause. I'm the co-host of the Property Powers Australia podcast, and in this episode, Sam Powell and myself chat to Steve Palise, who is the founder of the buyer's agency firm called Palise Property, where they've bought over 1,000 properties for clients, and he's also the author of the book Commercial Property Explained Simply. And in this pod, Steve, Sam, and myself, we talk about why you need to know your property goals before even choosing what type of asset you should be buying in the commercial space. And what sort of goals should you have? Is it passive income? Is it also capital growth? How fast do you want it? And then what type of asset do you need for maybe your risk tolerance too? We also discuss what are the top metrics you need to be looking at to choose to choose the right commercial asset for you. And then we talk about anchor tenants. What are anchor tenants? Why they play a key role when choosing the right assets in the right location. And lastly, we discuss LVRs and interest rate fluctuation risks that you should be aware of when acquiring your commercial property and what LVR you should be shooting for or maybe not shooting for. And there's so much value in this podcast episode. Let's just dive straight on in.
Welcome to Property Pals, the podcast where we share everything around how to build a property portfolio, from researching areas, financing, structuring, buying, selling, and reinvesting to live a life of financial independence. As a disclaimer, any information shared by myself, Jared, Sam, and the Property Pals team is strictly general and should not be taken as constituting professional advice. You should consider seeking independent legal, financial, and taxation advice from a qualified professional.
Welcome back, Steve. Everybody that is listening, we just did a podcast episode, the previous podcast, on how to find the best location in commercial. And now we're talking about how to find an asset and what to look for when choosing an asset after you've found the target location. So thanks for jumping on, Steve.
No, thanks. Feels like I was only talking to you guys 10 minutes ago.
Absolutely.
Still wearing the same shirt.
Wink, wink.
That's all right. In my defense, I actually own 3 black t-shirts and 3 white shirts, and I just cycle through them. I don't have to think.
Yeah, you just need Palise Property somewhere on the
Zuckerberg and what's his other name? The iPhone guy. That he used to wear the same,
Steve Jobs.
Same thing.
Well, he's not here anymore, is he?
He's probably still wearing a shirt though.
Yeah. Unless
All
he
right.
got cremated.
So what makes a good asset
sidetracking.
not such a good asset?
A good asset for commercial is something that has always got a tenant and gives you the cash flow that you're trying to achieve. If you're focusing on capital growth, like we mentioned on the last one, then it gives you that. If you're focusing on cash flow, it gives you that. If you're focusing on both, it gives you that. The main risk with commercial, that's probably the way to answer the question, is if it has long periods of vacancy. Like that kills people financially in most circumstances. If you buy a dud and it sits there vacant for 12 months, 24 months, 5 years, having a big mortgage with no income really hurts. So that's probably the biggest risk there. And that's why my whole job is try to mitigate that part of the risk. The next one, sorry, do you want to say something, Sam?
Yeah, my mind was just going, you're probably going to jump in this anyway, so I'll let you riff it, but while I'm holding the mic. What about the build type, like the condition of the building? Is that one of them that you look into?
Yeah, but that's in regards to the maintenance cost effectively. So same as residential, if you buy something really, really old, you have to budget for renovating kitchen, bathroom, new carpets, air conditioners blowing up, roof collapsing, knockdown rebuilds and stuff like that. You still have that in commercial. The benefit of most commercial is the tenants pay all the outgoings, including maintenance. So they look after that. But certain types of commercials, that's still going to apply. So if I buy a freestanding warehouse and the roof collapses in during a storm, for instance, and the insurance doesn't cover it for whatever reason, the tenant is not going to be like, don't worry, guys, I'll look after this. They're going to come back to the owner. Even if it says they look after maintenance, it's still something you need to budget for. So that's probably the aspect there. Certain ones, you can mitigate that risk. So similar to buying let's say an apartment or townhouse, you look at the body corporate and you look at the admin fund and the sinking fund and their plans and how much kitty they've got there to support that. So like arguably buying a body corporate warehouse is actually lower risk than having a freestanding one, because there's already money there and you're sharing the risk with 10, 20 other kind of owners and investors. But in saying that, you're also responsible for their one. So it's kind of like a risk profile there. Whereas if you own the freestanding, you're generally going to have to look after the structure and things like that. However, you've also got more value add opportunities, which we'll talk about, I imagine, on another podcast. But like you can split tenancies and add solar and do all that kind of jazz. So, looking at the property, it's regards to how much buffer you need for maintenance. All right. The next one is actually interest rate fluctuations. So you need to, same as residential, how you want to kind of set your buffers for if interest rates go up, how much negative cash flow you can handle. That also applies for commercial if you're highly leveraged. So if you go out and you pull out equity from a residential and you use that as a deposit for a commercial, you're effectively going to have 100 or 105% LVR. So unless your net yield is higher than your interest rate, which is tough at the moment because commercial interest rates are like 6.5%, 7% for most people, it's going to be slightly negative. Still better than residential. Like residentials are 20, 30 grand negative, and we're talking neutral-ish for a commercial. But if they do go up 1 or 2%, you need to be able to handle that. So you can kind of buffer there. Weirdly, the way to kind of mitigate that is to have a pay down strategy. So if you can't handle that, get it paid off as quick as you can before a lease finishes. And then that way you're covering yourself that way as well. But yeah, they're probably the main two I'd probably consider the kind of big risks when you're looking at it.
I guess one thing that's coming into my mind with like asset selection, and obviously due diligence processes is like highly important in any investment. Obviously, we talk about reducing risk every step of the way because investing is inherently risky. It's what makes a good asset is the low risk nature. But like I know you've got about 100-point due diligence check with your your purchasing. So with those due diligence checks, what are like those key checks you're checking with? There's a lot of checks in that question. With asset selection, when you're going down that path for your clients.
All right, so I'm going to assume asset selection, you mean whether like once you've sort of got an area, whether you go industrial or retail or office and things like that. It's probably the balance between the risk and reward. So like the vacancy versus what cash return you're getting. And then, like I mentioned before, like what you're actually trying to achieve from it. So like office play, you're purely playing a net yield game. You're trying to get as good a net yield as you can, but it's also susceptible to them building like another 20-story tower and completely flooding the market. Hence why you'll generally get a better yield. 20 years ago, that wasn't a thing though. Like in office space was really in demand. Like where I grew up in Parramatta, you couldn't even find an office space. Like it was that tight. Now that's a little bit different with interest rates high. And then same thing for industrial and retail. It's working out what kind of vacancy you're going to get versus return. But again, this all goes out the window because it depends what you buy. Like if we're talking retail and it's a little suburban strip shop with a medical center, a cafe, a barber shop, a massage place, a physio, dentist, whatever it may be. That one, you've just got that sample size to look at kind of the risk profile of what stuff renting for, what the vacancies are. But then something like a medical center, that could be around the corner. It could be a freestanding building. The foot traffic of that retail strip has nothing to do with that because people are going specifically for that. So it's getting that kind of balance right with the type of retail that you're buying there. And then industrial, it's probably a bit easier for most people to get a grasp on the kind of location data because you can look at every other warehouse in that complex, what it rents for per square meter, what vacancy period was, when they last sold. Then you can go to the next complex within a kilometre radius and look at those. So all of a sudden you get a bit of a tally of 20 different items where you're like, okay, this vacancy was this one was this is what it's renting for, this is how much this has gone up. And you're sort of making a bit more of a business kind of logical decision. Whereas like a little retail strip of 10 shops, the one that's a kilometre away has nothing to do with it. Like how many times have you been to a retail strip and some of them are like ghost town and you go to other ones, there's a huge buzz and people going everywhere and that. And because some of the key anchor tenants play a part in that as well.
Yeah,
can you mention what that is, like key anchor tenants, like what you mean, just so people can understand that? Because I'm fascinated, like what does make these, those little strips buzz versus ones that don't?
Yeah, the supermarkets is normally the big one. So like, well, I buy a lot of ones where they're suburban or regional ones where they've got like the big IGA and there's nothing within like a 5 kilometer radius. And then that's where we mentioned on the last podcast, talking to a town planner is really, really, really important, because if they're planning to build a Woolworths a couple blocks away, that might kill your foot traffic to your little center. In saying that, it can actually sometimes benefit as well, depending on what type of asset you have, because that obviously brings car traffic and foot traffic and kind of opens up the area. But yeah, anchor tenants would normally be a major medical, or supermarkets are normally big ones, because that's what brings people in. They go, oh, I'm going to grab a coffee, and oh, there's a Baker's Delight there. I'll go get my bread while I'm shopping as well. And those kind of flow-on effects. So as long as you can get like 60% of the center where it's like critical stuff, they normally do well. You've probably seen the ones where you go on holidays and you go to the coastal towns and they've just got like a fish and chip shop, a bread shop, and they're either flourishing or they're completely dead based on the holiday season. So like that's completely different. Oh, that's seasonal. But if you're just kind of going fundamentals, yeah, try to get something with a major supermarket and no competitors coming in the near future.
Yeah, how can you tell, like, with if it's going to benefit or disadvantage it? So you said that if the Woolworths was going, like, say there's a complex near my place, it's an IGA, got a Flannery's, it's buzzing, and they've gone and built a Woolworths down the track, like just down the road. Sorry, how does do you sort of there's obviously risk there. You never really know what the impact of that is, but do you sort of have those due diligence checks that you run?
There's no formal data for it. That's the problem. So I don't want to say gut feel because that's the wrong word, but you just want to kind of analyze the business of how it's going to affect. It's probably more critical if the little shopping center you're looking at has an IGA or something like that where it may compete. But if it doesn't, if it's just like a little retail strip that doesn't include that, that will probably benefit it, because it's a reason for growth of the area as well. It means population's going to grow. Same as like if a Bunnings is opening up nearby, that's a pretty good indicator that the residential market's going to do really well, because they don't just go spend 50 mil on a land site to build it there and it not work out. Like there's going to be a lot of houses and population growth, and that's going to get it. And just exposure as well. Just like if you can be on like a main road for the retail strip and they've got to drive past that shopping strip to get to Bunnings, that adds to foot traffic and road traffic. It's exposure. So there's that benefit. But again, it's completely dependent on where you're buying. Like a regional area, that's different to CBD. I actually don't like CBD retail. Like if you walk around in Sydney, like 1 in 30 shops is sitting there vacant, because there's actually weirdly too much competition than people working from home now. Whereas at least the suburban one, you can go, cool, what's the population? What's it doing? What are they changing from low density to medium density and high density? Are they building any more shops nearby? And that's probably, it's a bit of a side note, but like changing from low density to medium or high density opens up a few commercial normally as well, because the councils normally approve where like you see big apartment and they'll build like a cafe or something down the bottom. That we'd have to be mindful if you own a cafe or something nearby as well. But on the whole, it should improve. If you've got another 500 people moving in nearby, they're going to want coffee, for instance.
Yeah, I also like the fact it's kind of a bit of a land bank in a way too, with good income. Like say in those regional or outskirts, you get a site, good exposure. It's been there for a while, you get good income, and then in 10, 20 years, if the zoning changes, there's that. You get a DA on that thing and sell it off or do it yourself.
That's the benefit, Sam, of commercial. So everything that you can do on residential, when they say, oh, look, I'm going to land bank and build townhouses, this, or subdivide, you can still do that on commercial. And you've actually got more options. You can actually go back to residential, which a lot of investors actually do. In some areas, residential is worth more than the actual commercial space. And other ones, it's the opposite way around. You obviously buy residential and then turn it into commercial. But it gives you the same value add opportunities as residential, plus more, because you can do all the other stuff we've spoken about on the first podcast of like changing like the actual property itself, like put it into more retail or split the tenancies up or add solar panel or advertising space, put telecommunications on top or add second streams of income or even off-peak. I've had some clients who've bought some properties. They're sort of like office retail, showroom ones. They actually rent out off-peak times. So they'll have like a jiu-jitsu gym who use it at a different time of the day, and then they use it for something else, for like an office-based one. So you've got all these other options, which sounds attractive. it can also give you analysis paralysis because people get stuck on it. And half my pet peeve with my client calls is, oh yeah, I want below market value with some value add opportunity, blah, 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 blah. And then you're just kind of like, well, all this stuff takes risk. Like it's going to have its own risk. The owner's not going to sell you a really good asset for cheap. So do you want a poor tenant or do you want a good tenant?
Yeah, I want to ask a question based on that. When people come to you and it might be their first commercial, they're coming out of residential and they've listened to a bunch of podcasts, YouTube videos, maybe read a couple of books, and then they've got this preconceived idea of what their first commercial property asset should look like and what they want. What are some of those preconditions and misconceptions that people think they want that's going to get them to their goals in terms of what a good asset looks like? Do you get that regularly?
Yeah, and normally it's because of something I've said. I'll kind of take it per like really, really literally. And then the biggest one is the value add. People always want this value add. It's very similar to residential. You know how everyone wants like subdivision potential or granny flat potential. However, most of the guys with 10 plus portfolios don't own a whole portfolio of granny flat potential properties. They've done it. Yeah. They've done it outside of that. The issue with the value add, especially like let's use industrial because it's probably the easiest trying to get your head around, is you don't do the value add unless the tenant moves out. So do you want to do it in the short term and have a bad tenant and pick up a good price, or are we going to buy a really good tenant? And if they're there for 15 years, what's the point of the value add? You're not actually doing it. You're better off putting the funds kind of elsewhere. My biggest pet peeve, I should say, is people have a preconceived notion about yield, and it always seems to be a perfectly round number. At the moment, everyone says they want a 6% plus yield. 4 years ago, every single person said they wanted a 7% plus yield. And it's just a made up number. You'll send them a cracker of a deal at 5 point. They're like, no, I don't want that. And you're like, it's literally $2,000 a year difference in cash flow. And it's a better asset, a newer asset. And the stuff like that people said no to 5 years ago at 7%, that's had 30, 40% kind of growth since then. So now would be like a 12% yield. So people forget about the big picture and focus on the same as Resi. Oh, I want a 5.5% gross yield. It makes no difference whether it's a 5 or 5.5 in the grand scheme of things.
That's where my comments always come in. There's no perfect property, but there is a perfect portfolio that you can build out. So don't get stuck there.
This sounds a bit flippant, but I always tell people just buy to the fundamentals and make sure you buy something that's going to be in demand. There's too many external factors. My biggest thing is just make sure you don't make a mistake. You'll always be in a better position. Same with residential. In 5-10 years time, they all generally double every 7 to 12 years kind of thing. You'll be in a better position, but people just get caught up on the smaller stuff. And again, that's what makes commercial hard because as you said, there's a 100-point checklist that I go through. You've got 100 things you can get caught up on and say no to the property for. And I can tell you this, 9 out of 10 properties I look at, there's at least 3 to 5 things wrong with them that you're not quite sure about or you're taking on a risk. That's just part of the game as well. If it was guaranteed and risk-free, everyone would do it.
I got a question based on that, how many properties you look at. But Sam and I mentioned this in another episode about a unicorn property and the opportunity costs that you can lose out on by waiting for the perfect assets for too long. You could miss it versus just sticking with, like what you said, sticking with the basics and just buying something that's solid with minimal risk, get in earlier than trying to find the perfect ideal thing and miss out all the benefits of the compounding growth, however long you're out of the market. And then I wanted to ask, you mentioned, you might look at 10 and 9 of those 10, there'll be something not quite right about them. So how many do you look at in overall for a client? Do you look at like 20? Do you look at 30? Do you look at 9 before you get like the one that you typically acquire?
I'll take a step back and kind of answer what you said before about looking for the unicorn property. Like I'll use my personal example. So like I found a cafe, a freestanding cafe with 10 car spots next to Ipswich Station in Brisbane. That was $430,000. And I offered it to 3 different clients, one after the other, and they all said no to it. A lot of the no's were based on what I said about it. Because I said, look, this is a bit higher risk. If you lose the tenant, it's probably going to be a year or two kind of exit. But it's got upside because there's 10 car spots, you're next to a train station, you can build up to 42 meters tall. So that client didn't like the vacancy. think the other one from memory didn't like Ipswich. They were just like, oh, I don't want to buy Ipswich. It's a hole. No offense to anyone who lives in Ipswich. It's actually not a hole. It's quite a lovely spot. So they said no to it as well. When I talk about that one on like podcasts or on sales calls and stuff like that, people are like, oh yeah, get me something like that. But it's funny, in reality, they said no to it because of the risks. However, even though it's got all that, like it's done really well, it's kind of gone up like probably an extra 60% in value. I actually rent 10 of the car spots out to commuters, and that gives me an extra like $6,000 a year. It's got all these kind of cool things. A typical warehouse that I bought has performed better. Like a boring warehouse with a tenant has grown by 40, 50%. The rents have gone up about 50% in the last 4 years, and you've done nothing. So that's the point I was trying to make, is get into something that's kind of ticks the boxes at the start. If you've got a couple properties or you can take on a high risk kind of strategy, cool. Have some fun with that type of stuff, but be aware it's a job. I buy commercial to be passive. Other people buy it and they want to make lots of money really quick, which people in my team are like that. They buy commercials, do really big value adds, but it also takes them 20 hours a week for a year or two to get there.
Yeah, what's your time worth? With your processes, right? Like, do you just go hunting for properties, and when because obviously you're buying established predominantly, and they just come up, they come to your awareness, and then you do that research. Is that sort of the way you go about it? Or when people come to you, do you really define like, all right, well, based on this conversation, you're looking for either retail or industrial, this is your yield, and then when it comes through you present it? Or is there kind of like a way that you strategize the process?
It depends on the person. So I always say to them, look, like I work for you. Like my job is just to inform you what the risks are, and then we kind of go from there. So some clients will be completely open and they'll say, I don't care, Steve, just find me something that you think fits my risk profile and we'll go out. Other ones come to me and say like, look, I only want industrial. I really like industrial. And then we kind of target the industrial for them. Other people have a location one. They go, look, I'm really heavily invested in New South Wales and Queensland already. Can we not buy in those states? They go from there. But like you said, it's assessing what their risk profile is, what their budget is. I'm really transparent. Even before they've signed up for my services, I'd tell them what I'm buying, where I'm buying, what yields I'm getting on the sales call, so they can at least kind of look and go, okay, that's what I'm going to get. And they might gravitate towards something. They might actually go, look, I'm okay with retail. Let's go there. Other ones say no. So it just depends on the person. It's ultimately I get paid either way. And I know it sounds a bit weird, but my job, if I want to make money long term, the better they do, the quicker they come back for number 2, number 3, number 4. But it's their risk. So my job is just to present the data to them, so at least make an informed decision.
I like it. There's a lot around asset selection, and that we obviously touch in on. And end of the day, it's just be educated, understand that there's pros and cons to each, and there's always a bit of a risk. But I mean, the biggest risk for, I guess, me and my journey is that, like, I don't know, you, Steve, are you still learning every day, mate, with what you do?
Yeah, still learning. It's sort of shifting into different aspects, but I still learn, because we're doing, like I said, 10 to kind of 20 deals a month. Like I'm seeing what can go wrong, so I'm kind of learning in the right regard. But you learn more as you go. If like I've learned so much in the last few years about buying off the plans, because we've actually started actively looking at it. Now I'm looking at development sites, so I'm learning a lot about that. So your learning just shifts into different kind of entities there. So it just depends. One of the points I just sort of thought of that's probably worth mentioning is the hard thing about asset selection once you've got an area is a property might not come up. So like with residential, most people say become an expert in an area. So once you've chosen like, oh, I'm going to buy Adelaide, this kind of region, you can really go to town and actually learn like all the stats and like population growth, vacancy, days on market, how many people are going through properties and rentals, yada, yada. Like you can start collating all that. And a property will come on at some point that you can buy at a market price at least. With commercial, say you decide to buy retail and you're like, oh, I'm going to focus on this area of Sydney or Brisbane or whatever it may be, a property might not come up. So what's the point of doing all that research? If you miss out on the deal, you're kind of back to the drawing board, which makes it really hard. Whereas something at least like office and industrial, there's more of them, so you're more likely to see something come up. So different asset classes will kind of change your perimeter of what you're able to look at and get knowledge over.
There's a bit of a question that jumps in my mind, and it's a little bit off topic, but still, like, You are very educated on the investment space. Do people with businesses come to you and ask you, look, we want to expand in our business operations into Western Australia? Do you help them, with the asset selection on that front as well?
Yeah, still definitely help that. Most of the time they come to us and it's actually just because we've got better contacts than, or they don't know what they're doing. They're probably the two biggest ones. Like they'll say, oh, we've been looking for the last 3-4 months. We can't find anything. Can you help out? And we get like 60% of our stuff off market. So we can kind of help them there. I try not to sell that because it's like me just having access. I don't think it's fair to charge there's a huge fee for it. But most of the time I actually find business owners don't understand real estate. That's not their forte. They say they own a plumbing company. They have no idea what the cap rate is and how to structure like the new lease and things like that. So we definitely still, it's probably only about 10% of my business, but that's fun. That's a bit of a different one. I don't know if we're going to get to it on another podcast. Is you're obviously not looking at a tenant. So you're not trying to find something tenanted. You're actually trying to find something vacant or something with a short lease on it. So that's a bit different.
Yeah, that's actually our very next podcast.
There you go. Look at that.
Yeah,
we might be wearing the same shirt.
Yeah. We'll be talking. So, guys, jump on to the next one. It's going to be buying commercial property with tenants versus without tenants, the pros and the cons. But, Steve, you've got a book for people that they can go away and grab from your site, paliseproperty.com. Is that right?
Yeah, that's right. We've got a book. So I think if you guys use, Property Pals, the code, you get it for free.
Yeah. Awesome. So check that out, guys. There'll be links to that in the show notes. If you didn't watch the one prior to this, it's about choosing the location. And then next one, we're going to be talking about tenants or no tenants for commercial deals. So thanks again for coming on, Steve.
Awesome, guys. Thank you.